Welcome to the deep dive. Our mission here, well, it's pretty simple. Cut through all the noise, sift through the info mountains, and get right to what really matters. We want you to walk away with clear, concise insights. Well-informed, maybe even a little surprised. Today, we are diving deep into a really fascinating company right at the forefront of this AI revolution, SoundHound AI. It trades on the NASDAQ, ticker SOUN. We've gone through a whole stack of sources, articles, research reports, financials, everything publicly available as of July 3rd, 2025.
Yeah, and the big question we're tackling is this. You've got these huge tech giants, right?
Yeah.
Google, Amazon. Can SoundHound's independent voice platform actually build something lasting, something profitable? Or is it, just going to fade away, just an echo? And that's where it gets really interesting, especially when you look at its current valuation, around $11.26 a share.
Absolutely, because this company is, well, it's full of contradictions. We're talking explosive growth on one side, but significant losses on the other. By the end of this, you'll get why it's not just a simple buy or sell, it's really a bet on a very specific kind of future. So let's kick things off with Chapter 1, Business Analysis, the voice of the future. Okay, so at its heart, SoundHound AI is a white label voice AI platform. Can you unpack that for us? What does white label actually mean here, and how is it different from, say, Alexa or Google Assistant?
Right, good question. So basically, SoundHound isn't trying to be the next Alexa for consumers directly. Instead, they build the underlying voice AI tech, the engine, if you will. And then other businesses plug that engine into their own products under their brand name. That's the B2B part, business to business, sometimes B2B to C, where their client deals with the end consumer. And this is crucial because it lets SoundHound's partners keep control over the customer relationship, the data, their brand identity. They're not just handing that over to Google or Amazon.
Ah, okay. So they provide the smarts, but the client keeps the customer-facing part. Makes sense. How does that actually make the money? What are the revenue streams?
It's pretty diversified. First up, you've got licensing and royalties. So businesses pay fees to embed Houndify, that's their platform, into products. Think automotive, right? Maybe a per car, or based on how much it's used. Then there are subscription services, like a classic SaaS model, software as a service. This is for their enterprise stuff, like smart ordering for restaurants or smart answering for customer service, recurring fees.
Okay, licensing, subscriptions. What else?
Well, here's the one that could be a really big deal long term. Monetization and revenue sharing. SoundHound isn't just selling the tech. They're enabling new ways for their partners to make money. Imagine ordering food through your car's voice assistant. SoundHound could take a cut of that transaction.
Ah, interesting.
Yeah. Think about automakers. Right now, they get nothing when you use Apple CarPlay or Android Auto to buy something. SoundHound potentially turns that car dashboard into a source of ongoing revenue. It aligns their incentives perfectly. And finally, they do have a consumer application, the SoundHound Music app. It's freemium. Smaller revenue, sure, but valuable for gathering data to train the AI and gives them a direct consumer touchpoint.
Right, and all this is built on, 15 plus years of R&D. They must have some serious tech under the hood. What are the key proprietary technologies that really set them apart?
Oh, definitely. Two big ones stand out. First, speech to meaning. Most systems, they hear the words, then figure out the meaning. 2 steps. SoundHound does it in one go. It's faster and often more accurate, especially with complex requests.
One step, huh? And the other?
Deep meaning, understanding. This is pretty cool. It lets the AI handle really complex multi-part questions, like asking, show me Asian restaurants in San Francisco, but not Chinese or Japanese, that have outdoor seating and are good for kids.
Wow, that's specific.
Exactly. That's deep meaning understanding. It's AI that actually gets the nuance.
And they've packaged these into solutions for specific industries, right? Like drive thrusts, restaurants, cars.
Precisely. Vertical-specific solutions. Things like dynamic drive-thrus, smart ordering, chat AI automotive for custom, generative AI in vehicles.
So where do they stand now? How big are they in the market?
They've got some impressive wins. In automotive, big names. Mercedes-Benz, Hyundai, Stellantis. Their tech is going into millions of cars. And they're pushing hard into restaurants, already working with 15 large chains, including a huge pizza company with thousands of locations. They're processing billions of user interactions every year, and that data feeds back into improving the AI. They call it collective AI.
Okay, so the pitch to businesses. We're the leading independent alternative to big tech voice AI, but why would a big company choose SoundHound over, say, the convenience and scale of Google?
That's the crux of it, isn't it? It's the big tech countermove. Companies are increasingly worried about giving away their customer relationships and data to the tech giants. SoundHound offers a way to have sophisticated voice AI without becoming dependent on Google or Amazon. They get a customizable, data-secure solution where they own the experience. Big tech's models often rely on monetizing that data, which is exactly what these partners want to avoid.
Right, it's about control and owning the brand experience. Okay, let's broaden the view. Let's look at the industry itself. This conversational AI market is exploding, isn't it? What are the numbers?
Oh, it's huge and growing fast. We're talking maybe $14 billion in 2025, projected to shoot past $41 billion by 2030. That's a compound annual growth rate, CAGR, of nearly 24%. Some forecasts even see it hitting $136 billion by 2035. The key trends are towards more proactive AI, interactions across voice and visuals, really deep personalization, and generative AI getting integrated everywhere.
A massive wave they're trying to ride. So the competition, you mentioned the David versus Goliath scenario. Who are they up against?
Yeah, it's tough. Direct competitors include Cerence, which is focused purely on auto AI. They actually have a larger market share there now, but maybe slower growth. And Nuance, which is strong in healthcare and now owned by Microsoft.
But the real challenge comes from the giants.
Exactly. The indirect competitors are the big worry. Google, Amazon, Apple, they dominate the consumer space, have vast resources, huge ecosystems. And Microsoft is a powerhouse in enterprise AI with Azure and their OpenAI partnership. It's formidable.
Interesting point, though. Some sources mention data privacy rules like GDPR and CCPA. Could those actually help SoundHound?
Potentially, yes. Their model is inherently more privacy-focused because they aren't primarily trying to monetize user data themselves. Big tech's models often rely heavily on that data, which puts them under more scrutiny from regulators. So, yeah, regulation could be a tailwind for SoundHound's approach.
And getting into this space isn't easy, right? What are the barriers to entry?
Very high. You've got the sheer technological complexity, like we said, 15-plus years of R&D, patents. Then there's the data mode. Billions of queries constantly making their AI smarter. Hard to replicate that quickly. And crucially, high customer switching costs. Once you deeply embed SoundHound into, say, a car's infotainment system, ripping it out is a massive headache.
So that's their economic moat. What strengthens it?
Several things. Their brand strength and recognition as the go-to independent platform, boosted by deals like Mercedes and Stellantis. Potential for economies of scale. As they add more users, the cost per user should drop, potentially leading to really good profit margins down the line if they scale enough. And those network effects and switching costs we mentioned get stickier and stickier the deeper the integration. One source describes switching as prohibitively complex, expensive, and risky. That's a strong moat.
Like digital concrete, you said.
Yeah, exactly. Plus their unique assets like the proprietary tech, the collective AI architecture letting others build on their platform, and the flexibility on device, cloud, hybrid. That's key for industries like auto where you can't always rely on a connection.
So ultimately, that white label strategy is their shield against big tech. It aligns them with businesses worried about losing control. That's a powerful advantage, not just about the tech itself. Okay, fascinating business model. But what about the people in charge? Let's move to Chapter 2, Management Evaluation, Visionaries at the Helm.
Right, the leadership. It's definitely founder-led. Dr. Keyvan Mohajer, the CEO, co-founded it. He's got a PhD from Stanford, deep tech background. And his vision, apparently inspired by sci-fi, has been consistent for over 15 years. Enabling natural human-machine conversations. That kind of long-term focus and commitment is pretty notable.
So a technical visionary at the top. What about the rest of the team?
The core team, like James Holm and Majid Amami, also have strong technical roots. But they've smartly brought in experienced executives, too. A key hire seems to be the CFO, Nitesh Sharan. He came from senior finance roles at Nike. That combination, deep tech vision plus experienced financial leadership, seems like a good mix for navigating this high-growth, high-burn phase.
That blend does sound promising. How have they handled challenges? Any track record there?
A big test was customer concentration. Back in 2023, just 2 customers were like 62% of their revenue. That's risky.
Yeah, very risky.
But they actively worked on it. And now no single customer is more than 10%. That's a huge improvement. Shows they can execute on diversification.
What about communication and transparency? Any red flags?
Mostly standard stuff for a public company. There was a slight delay filing their 2024 10K, which they attributed to acquisition complexities. Minor point, maybe, but worth noting. We have seen some insider selling recently, like the chief product officer in June 2025.
Oh, should we be concerned?
Well, the key thing is, these were under prearranged Rule 10b5-1 plans. It's a standard way for insiders to sell shares for personal reasons, diversification, taxes, whatever, without it being based on non-public info.
Right.
So it's common, but yeah, you always keep an eye on insider activity.
Okay, standard practice, but monitor. Got it. So how are they using their money? Capital allocation.
Right now, it's all about growth. They're a high-growth company, not profitable yet, so they're aggressively reinvesting capital back into the business. Lots of spending on R&D to stay ahead technologically. That makes sense at this stage. They've also used M&A strategically. The acquisition of Amelia, for instance, helped them expand into new areas like banking, insurance, healthcare, opens up bigger markets.
Then things like dividends or share buybacks, I assume that's not happening.
No, exactly. No dividends, no buybacks. That's totally appropriate for where they are. Every dollar is better spent trying to capture that future growth.
Okay, but what about measuring their return on those investments, like ROIC?
Yeah, return on invested capital, ROIC. Right now, it's deeply negative, around negative 68%.
Minus 68%. Ouch.
Yeah, for a mature company, that would be a huge red flag, suggesting they're destroying value. But for SoundHound, it really just shows those heavy upfront investments in tech and market building. The whole investment case is a bet that ROIC will turn strongly positive in the future as they scale up and revenues start flowing. So summing up management, you've got that visionary founder, technical depth, combined with financial discipline from people like the ex-Nike CFO. Seems like a team structured to manage this kind of high-risk, high-reward strategy. Which brings us neatly to the numbers. Let's dive into Chapter 3, Financial Analysis. Growth at what cost?
Right. And the financials, as we hinted, are, well, a story of extremes. You see this absolutely explosive growth on the top line. But then you look down, and there are big losses, and they're burning through cash. It's quite the picture. So as of early July 2025, the market cap is sitting around $4.3 billion. That's a huge number compared to their TTM trailing 12 months revenue, which is just over $100 million. Clearly, the market expects massive things. And the revenue growth, this is the stunning part, Q1 2025. Up 151% year over year, $29.1 million. Full year 2024 revenue was $84.7 million, up 85% from 2023. That acceleration is incredible. It's really the heart of the bull argument. Okay, but then, profit margins. How bad is it?
It's pretty stark. T10 gross margin is around 44%, which is okay, but it has been volatile, dipped to 37% recently because of acquisition costs. For software, you'd hope for higher eventually. But the operating margin is minus 181%, and net profit margin is minus 183.65%.
Minus 180%, so they're spending vastly more than they're making.
Yes, significant costs right now relative to revenue. And that leads to free cash flow. It's consistently negative, and the burn is increasing. TTM burn was about $107 million. That's up from around $48.5 million back in 2020 and $109.5 million burn in 2024. They're consuming cash.
Okay, burning cash. But what about financial stability? Can they sustain this?
Well, this is where there's been a crucial positive shift. Earnings are consistently negative, yes. Profitability depends entirely on revenue growth, eventually overwhelming those costs. But look at the balance sheet. The debt-to-equity ratio has dramatically improved. They reduced debt down to almost nothing, just $4.6 million. And thanks to recent financing, equity is strong at $397 million.
So very little debt now.
Yeah, the debt-to-equity ratio is near zero, like 0.01. That massively de-risks the balance sheet compared to where they might have been.
Yeah.
And their current ratio is super strong, around 4.92. They have about $246 million in cash.
Okay, so that cash gives them runway.
A long runway, ample liquidity to fund operations and investments for quite some time, even with the current burn rate. That cash infusion was critical. All right, much stronger balance sheet is a big plus. But that valuation, how do you even value a company like this?
It's tough. Traditional metrics are kind of out the window. Relative valuation, PE is useless, negative earnings. The PS ratio, price to sales, is the one everyone looks at, and it's around 42.1x on a trailing basis.
42 times sales. That sounds incredibly high.
It is incredibly high. The average tech stock might be around 8x. Even a high flyer like NVIDIA is maybe 30x TTM PS right now, so 42x, it's astronomical. It means the market is pricing in not just growth, but sustained hypergrowth for many years and assuming they'll eventually achieve really high profitability. Compared to peers, Cerence is maybe 1.3x PS. Even successful software firms like ServiceNow, 13.9x, or Intuit, 11.5x, are nowhere near 42x.
So the market has baked in perfection, basically. What about intrinsic valuation, like a DCF model?
Doing a discounted cash flow is more about understanding the assumptions needed to get to the current price. To make that $11.26 share price make sense in a DCF, you basically have to plug in revenue growth over 30% per year for a decade.
10 years of 30% plus growth. Yeah. And you also have to assume they eventually reach really high free cash flow margins, like over 20%, typical of top-tier software companies. It's plausible, maybe, but definitely not a given. And you need a high discount rate, 15-20%, because it's so volatile beta around 3.0 and risky. So the financial picture is, yes, a hyper-growth star, but also, yes, a major cash-burning operation. The whole bet is that the growth wins out, and that newly strengthened balance sheet is the fuel making that bet possible.
Okay, we've dissected the business, the management, the financials. What's the general feeling out there? Time to look at Chapter 4, market sentiment, hype versus reality.
All right, market perception. If you look at Wall Street analysts, the consensus is a moderate buy. The average 12-month price target falls somewhere between $10.50 and $11.81, pretty close to where it is now.
But wait, here's where it gets really interesting. I saw the range of those targets. It's huge, like $3.60 on the low end up to $26 on the high end. What does that tell you when the pros disagree that much?
That massive spread is super telling, isn't it? It screens uncertainty and high-risk reward. It shows just how difficult this company is to value and forecast, even for people who do this for a living. It really highlights the speculative nature here.
How about recent news? Has that swayed sentiment?
Mostly positive buzz lately. News about growth, partnerships like with Alina Health, analysts talking up the $35 billion potential market for in-car voice commerce. The main negative recently was NVIDIA selling its stake. That caused a sharp dip, though temporary. So the overall narrative is kind of potential future leader, but yeah, still losing money.
And market indicators. What about things like short interest?
We don't have the exact number, but you see lots of references to short squeezes. And the fact that there's a 2x leveraged long saw ETF, ticker SOUX, that tells you there's huge speculative interest on both sides. It's definitely what you'd call a battleground stock. Bulls and bears fighting it out.
And technically, where's the stock price relative to trends?
It's a mixed bag right now. It's trading above its 50-day moving average, around $9.87, which suggests some positive short-term momentum, but still below its 200-day moving average, around $11.78, indicating the longer-term trend has been down. It really reflects that tug-of-war in the market.
Okay, a divided street, a battleground stock. Who actually owns it? Now for Chapter 5. Ownership structure. Who's at the table?
The ownership structure is pretty typical for this kind of company. Institutional ownership is fairly low, around 19.3%. A lot of the big conservative funds probably won't touch it until it's profitable.
But any notable institutions holding it?
Yes, Vanguard is a top shareholder, holding about 8.73%. Having a long-term focused player like Vanguard involved is generally seen as a positive sign.
And what about insiders, the people running the show?
Insider holdings are quite significant, around 9.2%.
That's high. Good alignment.
Yeah, definitely a strong positive. It means management has significant skin in the game, aligning their interests with shareholders. And just to reiterate, those recent insider sales we mentioned were under those preset 10b5-1 plans. Standard procedure.
So not too concentrated, but significant insider and some key institutional stakes.
Exactly. It allows for decisive long-term planning because a few key people hold significant sway. But it also means you're placing a lot of trust in those individuals. Overall, this ownership profile fits. High insider stake gives stability. The low but growing institutional base, that could be a future catalyst. If they hit profitability, you might see a whole new wave of institutions buying in.
All right, let's put it all together and look ahead. Let's move into a structured look at the future with Chapter 6, Risk Assessment, a comprehensive SWOT analysis. Quick reminder, SWOT is strength, weaknesses, opportunities, threats. Helps frame the internal and external factors.
Okay, hitting the highlights from the SWOT. Strengths. That proprietary tech, speech-to-meaning, collective AI, the differentiated white label model, founder-led management, those key partnerships, Mercedes, Hyundai, and that newly strengthened balance sheet. Big pluses. Weaknesses, the obvious lack of profitability, the extreme valuation, we keep talking about those gross margins, which were okay, but maybe not stellar for software yet, and needing to constantly spend on R&D.
Okay, strengths, weaknesses. What about the upside and downside from outside?
Opportunities. Massive market size, that conversational AI TAM, expanding into new verticals like healthcare and banking, potential for new revenue models like those transaction fees, and hey, they could even be an acquisition target for big tech someday. And threats, intense competition, especially from big tech, macroeconomic stuff like interest rates or a recession hitting spending, geopolitical risks, maybe tariffs, and always the threat of some new technology disrupting everything.
Now, here's where it gets really interesting. Again, that paradox you mentioned earlier. SoundHound's biggest threat, big tech competition, is also kind of the source of its biggest opportunity. Explain that again.
Exactly. It seems counterintuitive, but think about it. Why doesn't a company like Mercedes just use Google's tech? Because they don't want to become dependent on Google. They don't want to hand over their customer data and the direct relationship. They want to own their brand inside the car. So the more aggressively big tech pushes its own branded ecosystems, the more attractive and independent, privacy-focused alternative like SoundHound becomes to these large enterprises.
So the risk isn't just competition, it's that companies might choose scale over independence.
Precisely. The risk is that enterprises eventually decide the convenience and scale of big tech outweigh the benefits of independence and data control. It's this constant strategic balancing act for their customers.
And we shouldn't ignore those macro threats either. High rates hurt growth stock valuations. A recession could definitely slow down companies adopting new tech like this.
Absolutely. Those external factors are always relevant. Okay, let's bring it all home. Finally, we arrive at Chapter 7, Conclusion, the final verdict. So putting everything together, SoundHound AI really does present two starkly different narratives. First, the bull case. You've got a pure-play company in a massive, fast-growing market conversational AI. They're showing truly explosive revenue growth. They have unique tech, a business model that resonates with big companies avoiding big tech dominance, a committed founder-led team, and major partnerships. And crucially, they now have that fortified balance sheet, lots of cash, minimal debt, gives them the runway to execute. It's fundamentally a bet that they can carve out a significant, profitable niche in this huge market.
Okay, that's the bull case. What about the bears?
The bear case hits hard on that valuation. 42 times sales. It prices in years of absolute perfection. There's zero margin for error. They have a long history of losing money, burning cash, and no clear line of sight to near-term profitability. Competition is absolutely brutal, the biggest, richest companies in the world. And those current gross margins raise questions about just how profitable they can ultimately become, even at scale.
So that valuation summary again, intrinsic value is all over the place depending on your assumptions. To get to today's $11.26 price, you need to believe in truly exceptional, decade-long growth above 30% and top-tier software margins eventually. Less aggressive assumptions, the value comes out way lower.
Which leads to our concluding outlook.
Yeah.
It's really neutral, but with a heavy dose of caution. This stock is priced for flawless execution of a very, very ambitious plan. If you're a traditional value investor, forget it. There's no margin of safety. You could argue there's a margin of danger.
But for a different kind of investor.
Right. If you're growth-focused, maybe have more of a venture capital mindset, then yes, it's compelling. But highly, highly speculative. The potential upside is enormous if they pull it off. But the risk of losing a significant chunk or even all of your capital if they stumble is just as real. It feels very binary. Big win or big loss, not much room in the middle.
Wow. So what stands out to you from this deep dive? It's definitely clear SoundHound AI is a company of extremes, a real high-risk, high-reward play in this crazy AI space. Gives us a lot to think about.
And just a reminder for everyone listening, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be taken as financial advice. Please do your own homework, conduct your own research, or talk to a qualified financial advisor before making any investment decisions.
Absolutely. And hey, if you found this deep dive valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on tickers they request, just $4.99 a month. Plus, over the next few months, we're planning to cover all of the S&P 500 stocks, and members get exclusive priority access to those. If you just want a one-off deep dive on a specific company, drop us a super thanks on YouTube. Your support really helps us keep creating these insights. Thank you so much for joining us on the deep dive. Until next time, keep exploring and stay well informed.